to my monthly update on alternative asset fund administrator and auditor league tables. There are over 600 fund administrators and 500 audit firms servicing the private markets. I am George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Note that our league tables are only made available to Convergence clients. League tables can be purchased at the Convergence e-commerce site, and that's convergenceinc.com. I will provide some commentary on the movement we saw from October 2020 to October 2021 in the market. I'm very pleased this month. I'll be joined by two great clients of Convergence. One is Tom Angell, who's a partner at Withum Smith and Brown and heads up their financial services practice. And my second guest today is Kieth McGowan, who's also a partner, but a partner at BDO, and he's a co-leader of their national asset management practice. Thank you again for joining us today. It's a pleasure. You've been a great client of the firm, and I know it's been a terrific 21. So heading into that comment, really like to hear you chat a bit about what you thought some of the major accomplishments at the firm were in 2021.
Sure. Thanks, George, and appreciate you having me on. Before we talk about 21, just maybe kind of go back to 20. So the pandemic hits, we shut our offices March 16th, and we're trying to figure out how we're going to finish busy season and get everything out the door. Luckily, our IT group was tremendous, and so everybody was able to work from home and get our work out. It showed us that we didn't all have to be in the office. And all of us, I think, at that point thought it was just going to be a couple of months. Our fiscal year, the way we kind of measure the firm is as of June of each year. So June of 21, kind of fast forward, was actually our best year ever at the firm and our best year for the financial service practice. Combination of things. One is obviously there's a lot of cash out there, so there's a lot of funds being started up. Our practice from the financial service aspect of it and the things we handle in our group are alternatives, which are typically hedge, private equity, venture capital, fund of funds in those areas, broker dealers, and we do over 100 broker dealers, and then the largest component were SPACs. So we are either the number one or number two firm in terms of launching SPACs. And obviously, December through April of last year was crazy in terms of the number of SPACs out there. We've done over 400.
Wow, that's impressive. That is impressive, yeah.
So we've done over 400 as a firm, and a lot of that were being launched in the first quarter. So it continues to be, a large driver of the financial service practice, but we've also been able to move upstream in terms of the types of clients we're handling. So, 2021 was a great year, and then the back end of or the beginning of our 22 fiscal year is looking really good. We're on the financial service side and the firm in total, we're ahead of pace from last year. So it's a really good start for 22 and, a great finish for 21.
What's interesting, Tom, as you know, we do these monthly league tables and we look at market growth and we are really seeing, when you look at, say, the top 50 audit firms, and let's say assurance practices to be specific, we're seeing, while the big four seems to keep pace with market growth, we've really seen kind of audit firms 5 through 50 are clearly outpacing market growth, and so we're just seeing a lot of specialty work like SPACs and SPVs, and we're also seeing a lot of new launch activity, which is really kind of being spread more. I don't want to say down market, but more to beyond the big four. So it's been interesting to watch, and we're seeing that in both the audit side and the fund administration side. It's kind of interesting that people moving past, say, the top four, or the big four, the top 10 firms in the market. You mentioned COVID. So obviously it's impacted all of us. But what I was going to ask you is, how do you think COVID's reshaped your firm, right? How do you guys think about the market, the marketplace? What are you doing maybe differently? And are some of these things you're doing differently kind of, wow, this is maybe a better mousetrap anyway,
Right.
So curious, kind of how you mentioned IT helped get you set up remote very quickly, but how's it really reshaped the firm?
It's interesting. I think a lot of the thought process when everything first hit was this was going to be a short-term issue. We figured by summer we'd be fine and everything kind of be back. And then once we kind of realized that wasn't going to happen, we tried to reshape our thinking on the marketing end. So our biggest push, from the time I got here with them, and I've been here a little over 6 years, was to brand the firm. Because at the end of the day, in the alternative space, it's not whether or not we connect with the GP at a proposal meeting. It's whether the LPs know us and will accept us as the auditor. So we spent a lot of time sponsoring conferences, speaking at conferences, attending conferences, and that all got cut away. So we tried other things. We did try some of the virtual conferences, but felt that they just weren't effective. It was just hard they would have these network rooms and it was just not a really good flow. So we kind of shut all that down. We went back to spending more time on an individual basis with our referral sources. So the attorneys, the prime brokers for the hedge funds, the administrators for the private equity, venture capital funds and hedge funds, and really spent a lot more individual time with them. But I think now that things have opened back up, we've realized that, everybody kind of wants to be together. So we've gone back to sponsoring conferences. I just spoke at something in New York the beginning of October. A lot of people were having events in September, kind of rooftop bars. So in New York, you have the vaccine mandate to be able to get into a restaurant.
Right.
You didn't need it to go to a rooftop bar. So there was a lot of kind of changes to try and adjust to all that. But from what I hear in the marketplace and people I talk to and our referral sources, everybody's going back to the conferences. The early ones weren't as well attended as they had been in the past, and that's understandable. But we definitely see a lot of that going back. So for our purposes, being able to have close contact with our main referral sources was great, but it doesn't get us in front of the LPs that eventually decide our fate. So having these conferences and going back, and we were specific in terms of the type of conferences we would sponsor. We wanted to make sure there were large institutional LPs there. So at least our name would be recognizable and not, an automatic, we don't know them. So we're going back to that. But I think what we wound up doing is building a lot more individual one-on-one relationships with our main referral sources. And to your point before about, so many more funds kind of going to the middle layer outside the big four. Well, all of our referral sources for those funds are getting more work. So that kind of comes to us as well. So, all that's happened. The firm itself is in a growth mode outside of organic growth. So acquisition mode. So now we have 3 offices out in the West Coast. We have one in California, one in Irvine, California, and one in San Diego. So we brought some people out there, and none of those offices were financial service specific, but obviously San Francisco and LA and somewhat San Diego are alternative investment specific. So, that hedge PE. So we're building out a team out there to kind of help at least have boots on the ground to deal with our referral sources that are out there we don't get a lot of time to spend with other than on calls.
Let me ask you this, and not to throw you a little curveball, but what about just quickly the war on talent, right? One of the things we are hearing just from every audit client on almost every admin client is, I can't hire enough people. I can't find them.
Yes,
Are you guys faced with some of that?
we're all in the same boat. Yeah, I mean, we've we've brought in a lot of work, and we know March is going to be tough, because all the SPAC 10Ks are due that month, and we have a number of funds that have 331 deadlines in their docs. So that's gonna be a little tough. I mean, we're doing alternative things. We originally set up an office in India more for the tax work, but we probably have about 30 auditors now based in India,
Okay.
that work on engagements. We've had secundees from South Africa last year and again this year, to help with the shortage because we were just bringing in so much work. So we're trying different things to deal with the talent issue, but everybody's going through the same thing. And in fact, some of the providers out in the marketplace that are lower than we are, have raised their prices. We've noticed on proposals we've kind of gone up against them before. We'd always go in knowing if they're in the room, we're not going to get to a price that they're at. And if somebody was just more interested in price than anything else, we were going to lose that. But they've actually raised their prices because they're having trouble getting people. So
Well, yeah, it's funny you say that. I actually talked to someone yesterday who made that exact point, that they are bidding, but they're almost pricing themselves out of the deal because of capacity issues, right? And
right,
that's really what they're doing, right?
right.
And um, all right, so let me move on just to my last question, Tom, and I appreciate it. Just more of your outlook. I know your fiscal year has already started for 22, but kind of the outlook you have for the alternatives market in 2022. What do you think your guys' top priorities are for the alts market?
Yeah, so our goal is to continue to move upstream in the types of clients we're getting. We built the practice basically on emerging manager startups. That's, in our opinion, that's the best way to do it. Takeaways are very hard.
Yep.
Got to be right place, right time. They just have to have had a service issue, and so they're willing to talk to you. But you know, in my prior life, that was kind of how we built the business. Was we started with emerging managers, and then they stuck with us. And even though, maybe they were $150 million private equity fund, when they're on fund 3, fund 4, they have co-investments, and now they're over $1 billion. We're still doing their work.
Right.
There was never a feeling like we'll have to move on now. So that was kind of the game plan here, and we know we're making strides when we start to do takeaways. That's not our marketing goal or something we chase after. We try and make sure people know we're available, we're around. If we talk to them, we already know they're with another service provider. But having our branding out there has helped us be another participant in the room when they're looking to switch. And we've been able to win some of those jobs. So those are more established funds that already have fund 2 or 3, and so those are nice clients to win. And it shows our message is getting out. So I think 22, from an overall market perspective, I think is still going to be going gangbusters. I mean, there's just so much capital out there.
Yeah.
You know, we would talk about this back in 2007 and 8 when everything. We had the Great Recession, and you're wondering what's going to happen, and then all of a sudden, things start to pick up, and it's been rolling since that point. I mean, we really haven't had an issue. And I remember going to conferences and 16, 17, 18, and people talking about, well, is it a good time to set up a fund because the merry-go-round's got to stop at some point. So when's it going to stop? Well, here we are talking about 22, and
Hasn't stopped yet, right?
it's still rolling. So I think our challenges are no longer branding, although we will continue to do that because we need to. Our challenges, as you mentioned before, talent, just making sure. So typically, 2 years ago, we hired 15 people for our group. Last year we hired 25. This year we're going to do 35.
Well,
So it's a longer term issue, but we need to build that base. So in 3-4 years, we've got, the right talent at the right levels.
yeah,
I think we have a great culture here, so people don't necessarily leave. Our voluntary turnover is not a lot. And then when people leave, they're not going to other firms, they're going to private jobs.
right,
So,
right.
so if we lose them there, we're okay because, we hate to lose them, but also they could be a potential client down the road. So if we're kind of a farm system for some of the private equity funds and venture capital funds for controllers, CFOs, in the long run, that helps us out.
Yeah, I mean, listen, your point on growth's interesting, right? Emerging, and hopefully you make some of the right bets, right? That some of these guys should
Right.
grow. But we've continued to see takeaway is happening, and I think it's a good part of a hybrid growth strategy, emerging and takeaway, and being picking your spots, because some of these folks are having service issues. Some of these, there's a lot of qualified audits out there right
Yep.
now from
Yep.
what we've seen, and also some of these advisors are just growing where they'll add a second or a third audit firm to the mix, right?
Yep.
And then your last point you made on M&A is interesting. I always find it hard to believe that there's over 500 assurance practices named in SEC filings. So there's that many out there. So they're out there, right?
Right.
And there's a lot of small firms hanging a shingle with a handful of funds. So people, I think we think people just like I think we think we're going to see a little pickup in the audit M&A activity, because just this last year on the fund administration side has been unbelievable to
Yeah,
watch.
exactly. Well, and then I don't know the stats, but I remember reading it. But there's so many retiring baby boomer accountants. It's I think when they did the number 3 or 4 years ago, it was like 60% of the accountants out there at that point in time. So those firms, unless they have good succession plans, need to do a deal in order for the retired partners to have some kind of benefit going forward.
Right,
So,
and that's just to probably protect what you have.
Yeah, exactly.
Clients, right?
Yep.
So listen, all right. Well, listen, Tom, a real pleasure. I want to thank you for your time today, and thank you for being a great client of the firm of Convergence, and we really appreciate having you today. So wish you the best, and happy holidays coming up, and thank you again for making the time for this.
Thanks, George. Appreciate it. Appreciate the invite, and always appreciate the conversation.
Yeah,
Happy
thank you very
holidays.
much.
Happy holidays to you and your family.
Yes, thank you. So I want to welcome Kieth McGowan today, who's a partner at BDO and is the co-leader of their national asset management practice. Kieth, how are you today? Thanks for joining us.
I'm great, George. How are you?
A great November day, right?
Right.
And appreciate you making the time for us today. So Kieth, it's as we sit here and I look at the calendar, November 19th, and yeah, we're kind of wrapping up 21. What kind of year was it for BDO?
I think it's been so far. Listen, our year end doesn't really end until April of 22, but I think that the firm is continuing down a path of very, very solid earnings and growth. So I mean, I think there's a lot of reasons for us to continue to be excited about where BDO is going.
Yeah, well, listen, you guys have been a great client of the firm, and we follow your growth, and one of the reasons we have you on this is the growth's been pretty noteworthy. So congratulations on a solid year. I just wanted to talk to you about a couple things, and one of them was the topic everybody talks about, COVID, and kind of almost a two-part question, right? One, how has COVID really reshaped things at your firm, right? I mean, we know everybody kind of went remote at the beginning, but probably more importantly, people are doing a lot of things very differently, and maybe even permanently, because of some of the lessons learned and things that happened during COVID. Just interested in kind of your take on that in terms of BDO.
It's very interesting, George. I mean, from my perspective, the one wonderful thing about technology, and we can always say there are wonderful things and maybe not so wonderful things,
Right.
but the wonderful thing about the advancement in technology is that it allows us to bring a service solution from almost anywhere in the world. To some degree, I make the joke around the office that, and this is going back to pre-COVID, that, essentially for some of our clients, we could audit them from the moon. So, here in the asset management practice here in New York, for instance, we deploy, a couple of people that have been with us for many years because they had the relative experience, and somebody that we would want to be part of our practice that live in other regions. We have a senior manager that lives in Houston, for instance, and she's been with us for quite some time. So, and so we've always recognized that we could still service our clients without being necessarily, completely in their backyard.
Yeah.
So, and I do think that, in my view, and in my personal view, not necessarily BDO's view, that, COVID has probably has certainly accelerated the fact that people recognize that they can bring a service solution without necessarily being tied, 100% to a physical location.
Yeah. And on that note, like, I'm assuming you guys have cut down on travel and conferences and are looking to pick that back up as 22 rolls around.
Yeah, I mean, if I could take one more moment and talk about just the service solution, but things are changing, right? The world is opening up, and there is a social and training element that we believe is necessary for our people to really thrive. And we are trying to embrace people to think about coming back to the office. The firm has not made any mandates along those lines, but people are starting to. I mean, look at me. I'm in our Melville office today, but I go to our New York City office a couple of days a week, and people are starting to come back a little bit. Going back to your question on travel and those other expenses, especially around conferences and things of that nature. Obviously everybody basically went dark last year. We are starting to look at where we should make some investment. There's a well-known business development corporation conference that goes on in January. Actually, this year they did a line one. I mean, on-site one, and so we were a sponsor for that, and so we will be participating live in January there, and other ones we're starting to look at. But I think we really started out by saying, hey, let's get together with a small groups of people that are willing to come to New York or wherever. And I think we've seen a lot of people embrace the idea of starting to get together. So
Yeah, I think you're right, Keith. I think we're starting to see a lot of that. I think a lot of the feedback we got was a lot of the conferences that went virtual. People were pretty mixed on, and it was hard to just be in that virtual room and network. And I give people a lot of credit for doing that and keeping kind of the trains running. But there's kind of nothing like the conferences you and I are used to, where you can really spend some quality time with people. And I think people, to your point, are pretty anxious for that whole scenario to come back, right?
Yeah, it'll be interesting to see what happens. I mean, I think as a firm, we're very focused on the ROI, probably more so than we ever were. So we have to have a good, solid, strong case that that those conference costs are going to result in a positive benefit. Whether it be branding or obviously more building the practice. So, but I do think that we are continuing to start to look towards going back to live events, and
Yeah,
certainly
I'm laughing. We used to tell sales guys that they had to come back with 50 cards or they shouldn't come back, right? so all right, listen, last thing I really wanted to briefly talk to you about is just kind of your outlook for the alternatives market, right? Even though you're a little more fiscal, and we're getting into 22, but just your views on kind of the alternatives market, and maybe some of the top priorities you guys have as a firm
I mean, I think for our practice, and I'm not so sure I would just limit it to alternatives, but from a marketing and branding perspective, the one thing that we actually are trying to push forward is getting better brand awareness around the fact that we are an alternative to some of our larger players.
Yeah.
We just posted a new video on BDO.com's industry page for asset management, which are going to be using for social sharing and campaigns like that, because we think that the firm has done a really, really good job of elevating its brand in sort of like the public company corporate market. But we would like to see us push our mantra as well and make sure that people understand that we are a very capable international choice versus, the larger players. But that being said, I mean, I think our primary, there's two primary focuses. I mean, our venture capital business, our private equity, fund business, we're starting to see a lot of new emerging managers, which, I don't remember last time I said that, people coming out of either larger institutions or starting on their own. So that's sort of exciting. And then I think that, the other thing is, when we look at where our focuses are in, for next year and beyond, is expanding our fintech presence. I mean, whether it's, funds investing in various cryptocurrency, or, as our financial services practice is asset management, but also incorporates, banking, insurance, and brokerage, real estate. We're seeing things even on the blockchain side as it relates to insurance solutions and things along those lines. So I think from a strategy perspective, we're looking to sort of build out our quals in that area and try to drive growth there.
Yeah, I mean, I've heard, I think when you talk about branding, it's a good point. And, we're seeing, two things I would tell you that I think play to what you're saying, Keith. One, all the growth right now in the alternatives is in new funds, right? New fund launches, significant new growth. When you look at, especially closed end, right? When you look at hedge, while hedge is growing probably 12 or 13 or 14% in terms of assets, it's money going into existing funds.
Exactly.
Right?
I couldn't agree more.
Yeah, and then you're seeing that. And then the other comment I'll make that we're seeing out there is people, firms are really pushing business kind of well beyond the big four now, right? We're seeing great, while the big four does well in terms of market, pacing with market growth. We are certainly seeing when you get to like 5 to 10, audit firms 5 to 10 and then 10 to 25, that they're growing beyond market and the market pace. So, that tells us, and we're seeing the same thing on the fund administration side, right? That tells me that a lot of folks are very open to, high touch, specialty type firms that are very capable, partners, right?
Yeah, I mean, listen, we recently bid on fund manager that came out of a large institution that expects to be, sizable within a short period of time. And again, we always try to sell the fact that they're going to have a very high, partner, director, senior manager touch point, especially on the partner level. I mean, it's one of the things that we believe that we really pride ourselves on in terms of how we deliver our service solutions. So, so we'll see. But I think you're right. I mean, they're looking at us. They're looking at some other middle market firms. And so, we think we're in a good place to win that work. But we're seeing a lot of those opportunities now.
Yeah. All right. So Keith, thank you. I want to make sure that we are very appreciative of you making the time. And
thank you.
You've been a great client for a long time,
Right.
So appreciate that, and enjoy the holidays. They're right around the corner.
All right. Thank you very much.
Yeah, thank you, Keith. All right. I want to thank our guests. Now I'd like to make some comments just on market growth and kind of a league table roundup. So on the administrator front, we saw advisors disclose over 105,000 private funds. That's up about 10,000 funds, about 11%. And we saw advisors over this last year disclose assets of very close to 25 trillion, which is a net increase of 3.5 trillion. That's up almost 17%. When you think about the distribution, The top 25 administrators won about 45% of those 10,000 new funds. All other administrators won about 22%, and those who self-administer stayed at that 33% level. The top 25 administrators also won about 55%, about 1.5 trillion of the 3.5 trillion in new assets. All other administrators won about 12%, and those who self-administer kept about 33% of that. We continue to see strong growth, especially in PE and venture capital funds and assets. And even though hedge fund launches are down, hedge fund assets are increasing almost 14%. So, you know, the market is really growing at about 16%. The top 5 administrators really are the market is growing at a little over 6% in terms of assets. The top 5 administrators are growing closer to about 11 or 12%. The 6 to 10 are right at that market growth point of about 16 or 17. What's interesting is the 11 to 25 peer group of administrators are growing very close to 25%. So almost 9 or 10% higher than the market itself is growing. Let me now talk about audit firms in the market. So when you look at the audit addressable market, advisors disclosed over 105,000 funds over this time period. That's a net increase of about 12,000 funds available to audit firms. That's up about 13%. And those assets were also about 25 trillion. The top 25 auditors won about 2/3 of those 10,000 new funds, about 67%. All other auditors won about 6%. The top 25 auditors also won 89% of that 1.5 trillion in new fund assets. All other auditors won about 1, and about 10% of funds did not disclose an auditor. Convergence continues to see strong asset growth in PE, which is almost 23%, venture capital at 52%, and real estate at about 10%. When you think about the distribution here, as I mentioned, on the asset front, the market's growing about 17%. So when you think of auditors, the big 4 are growing just about the same, about 16%. 5 to 10, though, are growing at 32%, which is about double the market, and 11 to 25 are growing at about 23%. So, you know, almost 50% the market. So this continues to tell us that the market is distributing beyond just the top, right? We're seeing kind of mid and lower tier picking up some great market share over the last year. So I want to thank you all for joining me. I want to thank our guests, Tom and Kieth, today. Wish everybody a happy Thanksgiving, and I will see you all in December. Have a great day. Bye-bye.